Is the market overvalued right now? This is a potential warning to consider for all you long-term investors out there. I'm not here to panic you. I'm not here to tell you to sell everything. And I'm not here to tell you to double down. But I am here to walk you through the facts. Because right now, a lot of people are investing emotionally. And emotional investing is where the real money gets lost. So please, don't buy anything, don't sell anything, just sit down and listen. Over the past few months, the market has been climbing steadily, and it's raising an important question, and it's one that occurs every time the market has a nice run and it's at new highs or near new highs once again. Is the US stock market actually overvalued right now? The data, well, it's not pretty. The S&P 500 is trading at over an estimated 28 times earnings, which is well above the long-term historical average of 16 times earnings and the long-term median of 18 times earnings. That's where some are starting to sound the alarm. For the newbies out there, the PE ratio is just a way to measure how much you're paying for $1 of a company's earnings. So if a stock has a PE of 20, you're paying $20 for every $1 the company earns each year in profits. Think of it like buying a rental property. The PE is like the price you're paying compared to the rent that you get to bring in and put back in your pocket. A higher price for the same income, that means lower returns on your investment unless the rent is expected to grow. Same with stocks. A high PE can make sense if big growth is coming, but if it doesn't show up, your returns may fall flat. It's not that simple. Markets evolve and change and are dynamic, so let's dig a little deeper here. If you're asking, why are valuations so high right now? The answer isn't just pure hype. First, there's the AI-driven efficiency gains. Goldman Sachs estimates that AI alone could improve corporate profit margins by 1 to 5% or more over the next decade. That's not pie in the sky. It's baked into how businesses are evolving and adapting to new technology, and they can do more work with people trained in AI that drives better productivity and possibly better profit margins. Second, a different market than the past. We're not in the 80s anymore. Financials and capital-intensive industrials aren't leading the charge. Tech companies are, and tech companies reinvest heavily, grow faster, and trade at higher multiples because they are less capital-intensive, higher profit margins, and faster-growing businesses. So if tech is a bigger part of the index, naturally, valuations could rise. And third, strong balance sheets and global capital inflows. U.S. corporations, broadly speaking, are well capitalized in their finances. And in a turbulent world, investors have historically preferred U.S. markets. Fourth, historic resiliency of the U.S. market to volatility. The market has historically bounced back from fluctuations, especially here in the U.S. And the tendencies throughout history give investors confidence that getting in and riding out the ups and downs may be the most sensible path forward. The fact is that 96% of the 10-year time horizons for the market have been positive returns. And in the worst case scenario, you're looking at a downside of possibly around negative 3%. It's no guarantee, but it does paint a picture of how investors may be evaluating things. The only flip side is to not invest right now and just wait till evaluations are better. But we don't know if you will ever get that chance, or even if it does happen, what it would look like. The market could go up 20, 30, 40% and then correct, giving you only a day or two to get in when some panic or some crisis lands. But here's the deal. This is the hardest time to buy. And realistically, if you're scared to buy now when things are relatively good, the likelihood that you will buy when things are down and they look grim is way lower. The best time to buy, if it's suitable for your financial plan, is generally right now, or at least to get in a little bit in dollar cost average over time. The data shows that investors who try and time the market, on average, do relatively poorly compared to more patient long-term investors. So yes, valuations are high, and given AI and the fact that earnings this year are expected to grow by more than 10% for the entire S&P 500, there may be fundamental reasons to justify these higher valuations. And you may in fact do yourself more harm than good by trying to be the next major hedge fund manager and time the market and get in and out. But let's not get carried away with too much optimism, because risk is still very real. Number one risk right now is that valuations and expected future returns do correlate. Historically, buying higher PE ratio stocks means lower future returns. It's a basic truth that's been proven in data for investing. Higher valuations pull forward future performance. Secondly, there's a narrow market breadth. A small handful of mega cap tech names have really been carrying the rally, which creates fragility. If a couple of big companies stumble, the whole market could fall really fast. Third big risk is the macroeconomic headwinds: slowing growth, tight labor markets, persistent inflation pressures. All of these present risks, and there's no guarantee that the smooth sailing will continue indefinitely. Now, here's where most investors get it wrong. They want a simple black or white answer. Is it time to go all in, or is it time to sell everything and go to cash? But smart investing isn't binary, it's nuanced. If you believe in the long-term strength of the US economy, that doesn't mean you ignore the risks completely. It means you diversify, you rebalance, you stay invested intelligently. Maybe it's time to look more seriously at smaller cap stocks or international stocks or other investment opportunities that may fit into your financial plan. Maybe it's time to trim a little of your overweight positions, not because you're scared, but because you're disciplined. So what is the practical framework? Well, you gotta ask yourself, am I investing or reacting to the latest news? You have to reassess your exposure. Are you overly concentrated in one area? And do you have dry powder for any pullbacks? Or are you maxed out emotionally and financially such that a pullback would be really stressful for your situation? Being a long-term investor doesn't mean just sitting still. It means you're thoughtful, especially when the crowd gets very loud. If you want a second opinion on your portfolio, or you want to know if your retirement investments are positioned well and aligned with your goals for the future, let's talk. Check out the video in the description below on how financial planning can potentially boost your retirement nest egg. If you're wondering whether today's market is anything like 1929, which led to the Great Depression, I've got a deep dive into that as well. So please check that out in the link above here. Until next time, I'm Joe Boughan, and subscribe to our channel for more financial adventures ahead. Stay calm and stay focused. And until next time.